Good evening, everyone. Uh, Today we'll go for lesson 3, which is instruments of long-term finance. We already completed introduction to financial management, scope, nature, function, etc. Then we have completed DuPont analysis. Then we completed CVP analysis and economic value addition concept. Now let us go for instruments of long-term finance. Instruments of in this unit we'll read about five things: instruments of long-term finance, share capital, debentures, bonds, hybrid instruments, venture capital. Sources of finance. On the basis of time, there are three kinds of sources of finance: long-term finance, medium-term finance, and short-term finance. In long-term finance, equity shares are ownership shares. Preference shares, these are preferential shares which don't have any voting right, but they have preference over the payment of dividend, preference on payment of dividend over equity shares. Then internal accruals, that is reserves and surpluses, whatever is earned by the company over a period of time, that forms part of the internal accruals. Then debenture, bonds, loans. Debenture is an instrument of debt. Now then, term loans, venture funding. Venture funding is the funding to the new entities in the form of it may be in the form of equity or debt. Then asset securitization, when the asset is converted into securities and it is traded in the market, it is called as asset securitization. And international financing like euro issue, foreign currency loans, ADRs, that is American Depository Receipts, and Global Depository Receipts, etc. Then medium term finance consists of preference shares, debenture, bonds, medium term loan from financial institutions, government, commercial banks, etc., lease financing, hire purchase finance. And short term finance are like trade credit. You get it from your creditor, the person from whom you're purchasing your raw materials. Then short term loans like working capital loans, fixed deposits for a period of less than 1 year, advance received from customers, creditors, payables, factoring services, bill discounting, etc. Now, let us understand what how do we segregate into long term finance, long term source of finance, medium term source of finance, and short term source of finance. Long term source of finance is something which is more than 3 years. Medium term source of finance is from 1 year to 3 year, and short term finance is a finance which is repayable within 1 year. Now, on the basis of ownership and control, owned fund means the funds which are owners funds, equity capital, preferential capital, retained earning, convertible debentures which are to be converted in a future date into equity, then venture fund or private equity. Then in borrowed funds, loans from financial institutions, commercial loans, and debentures. So these are borrows. Now, basis of source of generation. So there are internal sources and external sources. Internal means within the organization, and external means outside the organization. So internal sources, we have equity capital, preference capital, retained earnings, convertible debentures, venture fund or private equity. And external are retained profits, reduction of working capital, sale of assets or loans. So these are the things. These are the sources of finances we have. Now let us know about the share capital, ordinary shares, common share. We all know it represents the owner's capital in the company. What are the characteristics? It is irredeemable, it is never redeemable. You cannot redeem share capital. That is why, unless and until a company is restructured, the share capital of the firm cannot decrease. So it does not have any maturity. It will remain with the company till the company ends. Now, residual claim on assets. So, the residual claim in the income of the company. So, in the income of the company, whatever, first of all, interest is paid, then tax is paid, then preference dividend is paid, and then whatever is left, that is paid to the equity shareholders. Variable income security. Income is not fixed, it depends on the profit earned by the company during that period. Residual claim on assets. Assets, the first claim on asset of the firm is of creditors, then of preference shareholders, then of shareholders. So last claim of on asset is held by shareholders. Then voting rights, they do have voting rights. Then they have preemptive rights. They have right to take decisions and limited liability. So the liability of the shareholders, the ownership shareholders, is limited to the extent of the shares held by them, the percentage of shares held by them. Types of share capital. Authorized share capital, this is the share capital, the maximum share capital which a company can issue, in maximum shares which a company can issue. Then issued share capital. Issued share capital, it should be issued, it should not be issues. It's issued share capital. Out of authorized share capital, how much has been issued. Called up share capital, this is the capital which is called up but has not been, the calls have not been received yet. And subscribed share capital, these are the share capital which have been subscribed. Paid up capital. Paid up capital means the capital for which the amount of capital has been paid. Now right share, these are the shares which are given whenever a company is going for any follow on option, a follow on issue, then the company offers its shares to the existing shareholders, maybe at a discounted prices, and to at and that this right of existing shareholders is these kinds of shares where they are offered first and then that is offered to the public. It is called as rights shares. And then bonus shares, these are the shares issued out of free reserves. Then sweat equity shares. Sweat equity shares means equity shares issued because to the employees of the company, the to the people who were giving their sweat to the company, who were giving employees to the company. These are in the form of ESOPs, employee stock option schemes, etc. So these are the types of equity shares or share capital. Now, what are the merits of equity share? No fixed obligation to pay dividend. Company can pay them dividend only if they earn profit. If the company earns profit, if the company doesn't earn profit, there is no need to pay any dividend. Then no charge on the asset of the company. There is no charge on the asset of the company unless and until other charges are fulfilled. Then only the residual charge rests on the assets of the company. Then permanent source of capital. It is never redeemable, as we already discussed. Real owners and have voting rights. Real gainers in case of profit. Demerits: no advantage of trading on equity. That is what the biggest problem is, because equity is considered as a most expensive source of financing, and they become the owners. They are not the people who are taking just the interest and sufficing. They will be taking interest in they can take interest in the business of the firm. Danger of overcapitalization. There can be danger of overcapitalization. If we issue more of equity shares, there can be over of capital available. Then obstacles to the management of the company. Now, it always becomes obstacles to the company because management of the company, because they are also the decision makers. Higher dividend during bullish market. So once the market is bullish, then you'll have to pay higher dividend. The high risk as compared to debt. Of course, higher risk, because if the company makes profit, the shareholders will get the money. If the company doesn't make profit, they don't get the money. So higher risk when it is compared to debt. Now let us learn about preference shares. Preference shares, more commonly referred to as preferred stock, are the shares of the company's stock with dividend that are paid out to shareholders before common stock dividends are issued, so they get preference dividends. If the company enters bankruptcy, the shareholders with the preferred stock are entitled to be paid from company assets first. Most preferred shares have a fixed dividend, while common stocks generally do not. So, preferred shares, they have fixed dividend, most of them, and pop shares, they normally don't have. So, preferred stock shareholders also typically do not hold any voting rights, but common shareholders usually do. So, preferred shareholders don't have any voting right. Now, shares are of two types: equity shares and preference shares. Equity shares we have already discussed. 8 types of equity shares we have already discussed. Then preference shares, again, they are of 8 types. That is cumulative, non-cumulative, participating, non-participating, convertible, non-convertible, redeemable, and irredeemable. So these are the 8 types of preference shares. If you look into cumulative preference shares, what are the cumulative preference? Cumulative preference shares are the shares where if the interest on the preference dividend on the preference share is not given, then that dividend accumulates in the future, and then that dividend is to be paid in the future with the whatever dividend is accumulated over a period of time. Non-cumulative preference share, if the dividend is not paid, for example, in 1 year, then that does not accumulate, and there's no obligation to pay in the future. Then participating preference shares also participate in decision making. They participate in what also happens is sometimes that after participating also means that once the interest, the the cumulative when they once the interest for the preference shares given, and finally whatever is left as equity earnings, preference shares have part in that also. So they get out of equity earnings also. So they are participating as shares as shareholders of final earnings as well. Then non-participating, most of the preference shares, they are not participating, and they get their fixed preference dividend. They don't have any part in the equity earnings of the company. Convertible means sometimes preference shares. Some of the preference shares, they are convertible over a period of time into equity shares. Non-convertible means they are not convertible into equity shares. They remain as preference shares. Redeemable and irredeemable. Irredeemable means the equity shares which are never redeemable, and they never get redeemed. They always lie with the company, and company keeps on paying preference dividend for them. Redeemable means they have fixed maturity period, and after that maturity period, they are not paid any amount. They're paid back their amount, and they go out of the books of the balance company. So this is a preference share. Now, features of preference shares: it can be redeemable, irredeemable, fixed rate of dividend paid on income. So we already discussed this. Cumulative dividend, there can be cumulative dividend. Preference on claim on asset, of course, over equity shares. No voting rights. Hybrid form of security, because it has a characteristic. Preference share has characteristic of both equity shares as well as debt. Because it has characteristic of equity shares because it is shares. It is not paid before tax. It is not paid it is not getting interest out of it. They don't Company cannot enjoy tax benefit on preference dividend. It has characteristic of debt as well, because the preference dividend is fixed. The percentage of preference dividend is fixed as similar to the interest. So it is a hybrid form of security. Then may be convertible, and it may be participating. We've already discussed these two characteristics of preference shares when we were discussing about the types of preference shares. Now, preference shares versus equity shares. Voting rights: preference shares don't have voting rights, equity shares have voting rights. Payment of dividend: preference shares get preference dividends, and they get preference over the payment of dividend when it comes to payment of dividend to equity shareholders. Repayment of capital, the holders of these shares have preference rights as the payment of the preference of share capital. So again, preference shares get preference over equity shares. And rate of dividend, the rate of dividend is fixed. In case of preference shares, in equity shares it is not fixed. Rate of dividend and convertibility, preference shares can be convertible into equity shares. The equity shares cannot be convertible into preference shares. Redemption, the preference are redeemable during the lifetime of the company. The equity shares are not redeemable during the lifetime of the company. So these are the differences, very important difference, preference share versus equity shares. Now, preference shares, what are the merits? Preferential payment of dividend, no dilution of control, because for the company it is very good because there's no share in ownership, so there's no dilution of ownership. Then income is steady and safe, no charge on asset, lower cost of capital because it is lower cost of capital as compared to equity share capital, preferred for cautious investors, and preferential rights on repayment of investments. So these are merits. Then demerits are rate of dividend is fixed, so company is always obliged to pay that. They've got fixed obligation to be paid. No voting rights, restricts the investors from enjoying higher profit. They would have invested in equity shares and they would have got more profit. No security of payment of investment. If company goes down, everything is lost because they have charge after debt. Then no tax benefits. There's no tax benefit available to the company. It is preference dividend is paid after tax. Not attractive for investors willing to take risk. Dilute the claim of equity shareholders. So it dilutes the claims of equity shareholders. Now let us go for debentures. The bonds, debentures are a debt instrument used by companies and government to issue the loan. The loan is issued to corporate based on their reputation at a fixed rate of interest. Companies use debentures when they need to borrow the money at a fixed rate of interest for its expansion. A bond is typically a loan that is secured by a specific physical asset. A debenture is secured only by issuer's promise to pay the interest and a loan principal. So this is the difference between debenture and bond. Now, types of debentures. They can be simple, naked, or unsecured debentures. Naked means unsecured debentures. Simple debentures, they do have charge on the asset. Secured or mortgage debentures. Then bearer debentures. Bearer debentures, the debentures which does not hold any name. Whosoever holds that debenture becomes the owner of the debenture. Registered debentures, these are the debentures which are registered with the SEBI. Redeemable debentures, these are the debentures which have fixed maturity period and they are redeemable after a period of time. Irredeemable debentures, these are the debentures which are irredeemable and they don't redeem over a period of time. They go with the company's balance sheet to the end. Convertible debentures, these are the debentures which are convertible into equity shares after a period of time. Then if we talk about types of bonds, then we have zero coupon bond. Zero coupon bond is a bond which is issued on discount of its face value, and that's why it is called a zero coupon bond. Then zero interest bond, because there's no interest paid on this, and it is also inflation adjusted. First debentures and second debentures. So first debentures and then second debentures. So first issues first the bonds are issued and then the second bond is issued. Then guaranteed debentures, these are the debentures which are backed by the guarantees of the some directors or promoters of the company. Then collateral debentures, these are the debentures which are collateral to some transactions. Then other innovative debt instruments, there can be n number of innovative instruments which can be made out of debt, equity and preference shares, and they form part of debentures. Wherever there is loan component, Wherever there is debt component, it will be part of debentures and bonds. Now, other innovative debt securities are equity warrants, secured premium notes, callable bonds, floating, variable, adjustable rate bonds, so and deep discount bonds, inflation adjusted bonds. Equity warrants are the warrants where a person is given a warrant and he can convert those warrant into equity share in the future. Secure premium notes. These are notes given where some premium is fixed for them and they can take it in the future. Callable bonds, where a person has option to call or purchase a bond. Float, variable, adjustable, so flexible rated bonds. These are the deep discount bonds where bonds are issued at huge discounts. Inflation adjusted bonds, these are the bonds where inflation is adjusted, they are adjusted to the price level changes. So these are the things. Now, features of debentures and bonds: they have fixed maturity. They are loan instruments. They are debt instruments. So they are similar to loans. They have fixed maturity period. They are long-term funds to the company. Then fixed rate of return, fixed rate of interest, unless and until it is floating rate bond. Then priority of claims on income. They are the creditors and loan holders. They are the first people to have claim on the income. And priority of claim on assets. No control over management of the company. They don't have any control over the management. They don't have ownership rights. And call features. They can call it whenever they want. So these are the features of bonds and debentures. Now let us go for debentures and debentures. Shares versus debentures. Now, shares are a part of capital of the company. Debentures constitute a loan. Shareholders are members or owners of the company. Debenture holders are creditors. When recommended by the board, dividend could be declared to shareholders, but fixed amount of interest in debentures paid before dividend declaration. Shares do not carry any charge. Debentures generally have a charge on the asset of the company. Shares have a restrictions issue at a discount. There is no restriction to issue at a discount on debentures. Shareholders have voting rights. They don't have any voting rights. Dividend is payable when profits are there. Interest is payable whether there is profit or not. And there's no fixed dividend, but rate of interest is fixed in case of debentures. So this is the difference between shares and debentures. Now let us go for merits of debentures. To the company, it provides long-term funds, lower interest rate than the rate of dividend on shares. Interest is tax deductible, no dilution in control, trading on equity, fixed ROI irrespective of inflation, flexibility to capital structure, and easy accessibility to finance. Now to the investors, it is fixed, regular and stable source of finance, comparatively safer investment, definite maturity period, more liquid investment, protected by the various provisions of the debenture trust deed and SEBI guidelines. So these are the merits of debentures. Let us go for demerits of debentures. To the company, fixed interest and principal are legal charged, hence to be paid even when there is no profit, so it becomes an obligation. Charges on assets limit the further fundraising capacity of the firm. So once the charge on the asset is created, then further fund cannot be raised. Use of debt increases the risk perception. High stamp duty, not suitable with uncertain future earnings. And to the investors, there's no voting right, hence no control, no claim on surplus assets and profits of the company. Interest on debenture is fully taxable. Price of debentures fluctuate with the change in the interest rate. Uncertainty about the redemption. So these are demerits of debentures. Now, hybrid instruments are more of coming together of equity part and debt part. So hybrid security is a single financial security that combines the two or more different financial instruments. Hybrid securities, often referred to as hybrids, generally combine both debt and equity characteristics. The most common type of hybrid security is a convertible bond that has a feature of ordinary bond but is heavily influenced by the price movement of stocks into which it is convertible. Now, hybrid instruments principally include preferential capital, optionally partially convertible debentures, foreign currency convertible bonds, structured notes, which are intrinsically debt instruments. So, they are mainly debt instruments, but because they are convertible in the future into equity, they are affected by the price movements of the equity as well. And each type of hybrid equity has a unique risk reward traits. So, financing can be preference capital, convertible debentures, warrants, or options. Venture capital. Venture capital is a financing that investors provide to start companies and small businesses that are believed to have long term growth potential. Venture capital generally comes from well off investors, investment banks, and any other financial institutions. However, it does not always take just a monetary form, it can be provided in the form of technical or managerial expertise. Though it can be risky for the investors who put up the funds, the potential of the above average returns is an attractive payoff. For new companies or ventures that have a limited operating history under 2 years, venture capital funding is increasingly popular, even essential source of raising capital, especially if they lack access to capital market, bank loans, or other debt instruments. The main downside is that the investors usually get equity in the company and thus a say in companies' decisions. So the biggest thing is venture capitals invest in the new companies and especially the companies which have less than 2 years of experience, and when they invest in the form of equity, then they take part in the management of the firm, and it is more of a risky asset because yes, they're investing in uh, less experienced firms, but yes, because it is risky, it gives you more of return as well. Now, features and types. So if you look into this, when and what we need it, so we have, if you look into the features, it is always issued to new ventures, it has high degree of risk, equity participations there, long term investment, participation in management, financing of new company, can be a debt base or convertible into equity, targets capital gains, so they always target that we'll invest today and we'll get future capital gains. Investment in innovation projects, mostly it is invested in the innovation projects, promotes startup culture to make capital gains. If you look into this diagram, then in x-axis we have time, in y-axis we have revenue, and if you look into this, in the whole business cycle is divided into 5 phases: seed, early, mid expansion, late expansion, this is mezzanine, and exit. During the seed, whenever the investment is made, this is known as angel investors. Then what these investors, the investors who are investing in seed, early, and mid expansion phase, they are known as venture capitalists. Then private equity is investing in early, mid expansion, lesne, and exit, debt investments, and mesne financing. So these are the things. These are the 5 types of venture capitals, where which are investing in 5 different phases of a business. Now, venture capital, what are the merits? Large sum of equity finance helps business to find easier and secured other funding alternatives, because once you invest in equity, then banks are ready to give you debts. Help in economic growth, promotes innovation, encourages startups, helps in fund flow, helps in capital formation. Demerits: long and complex process, detailed business plan to be drawn, legal and accounting charges, control over organization, and profit sharing. So these are the demerits of venture capital. So here we come to end of the long term instruments. I hope you enjoyed this session. If you have any doubt, please call and ask me. Thank you.